Hello guys, we are back. Our February 2024 Real Estate Market Snapshot is here, and man, I am fired up today. I don't know exactly what it is. Maybe it's the rain or it's the market, but a lot of interesting stuff going on. Generally speaking, I think pretty positive, so we'll find out. I try to stay away from good news, bad news, but if you're me today, I'm probably a little more good news than bad. So let's jump right in. I am Lance Martin, your host for the next half hour or so. Coldwell Banker, Town and Country. We have moved our market forecast date from March this year to April. I still do not have a date. We're working on some logistics and a few things, but we are definitely going to be launching probably the second to third week of April. We'll get all the details out shortly. So it's kind of hard to mark your calendar for the entire month of April, but we'll get it to you shortly. So stand by for that. Exact same QR code that we've been using now for a couple of years. All the stuff is there. You guys can go back and take a peek at it. The links, the whole 9 yards. Okay, so what is in the news? For those of you that have been following me for like, oh my God, Lance is completely obsessed with Chairman Powell. And I thought we were going to get rid of Chairman Powell for a while. Well, guess what? He's back. Generally speaking, I don't like anything that's going on right now. But what did I just say a minute ago? I'm feeling pretty good. I think we got a little bit of good news. And I think we got a little bit of good news. So let's go through it here. So what I'm going to do, for those of you that have been watching my videos here for a couple of years now, you may remember about 18, 19 months ago, June 15th of 2022. This is when Chairman Powell came out and basically gave what I refer to as his press conference that set the reset. He basically came out and said, we need to reset the real estate business, et cetera, et cetera. I'm going to play that video. I may be making a little bit of a mistake here. I'm going to play about a 2-minute video of Chairman Powell's press conference, take a little break, pay another 30 seconds and another 30 seconds. So we're going to play some video. Hopefully it works. But I want to set the stage because to me it ties into where we are, where we've been, where we're going, et cetera, et cetera. So we're going to play a couple of clips from the Fed press conference on June 15th of 2022, and then we're going to play the press conference from 6 days ago, the most recent Fed press conference that Chairman Powell just did a week ago. So as I click into this, the first one that we're going to play is about 18 months ago, and here we go.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously, and so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully.
Okay, so a couple of things with that. And the one thing that jumped out, when I first heard that press conference, I watched it live on June 15th of 2022. because at that point we had been about 8 months into this accelerated increase of the Fed funds rate, which by all ties back to mortgage rates, right? This is all what we're talking about. We're being very selfish. What is this doing to mortgage rates? But the thing that just sent me off into the moon is when he was talking about the price appreciations, slight pause. That changes now. That was the words that got my attention of, okay, wow, the real estate market is in the crosshairs of the Fed, and they have a goal to change that. Now, we can make an argument that maybe we should have, because a 20% appreciation in 2020 and a 20% appreciation in 2021 was unsustainable, and they in effect said, hey, it's too hot, which, by the way, we've talked about this in many, many market snapshots in the past. When it comes to real estate, we don't call it inflation. We call it appreciation, because we like appreciation. But when you start talking inflation, and then you start lumping in real estate, and as the Fed chair, you say that changes now, well, that got my attention. And quite honestly, it's had my attention for quite some time now. So that was that clip. This is basically a quote that's coming up in the next clip. It's a little bit shorter, and I apologize for the long windup. And if you've been watching my stuff, again, this is where he uses the word reset. We're going to reset the residential real estate market, and we want it to settle into a new place. So again, it's all talking about price. This is basically quoted from the next clip. So let's listen to that. By the way, the next clip is from the same press conference, June of 2022, June 15, 2022. It's a little bit shorter.
You know, I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels.
So
thank you very much.
You're welcome very much. So with that one, what got my eye is the word reset and the housing settling into a new place. And he specifically mentions early on in that little clip about if you're a home buyer, you know, it's a little frustrating, it's hard to qualify, you'd like potentially a little bit lower prices. All that's true. In the prior clip, he's also talking about supply and demand, which if you're not into this stuff, you might have said, wait a minute, what do you mean there's a large supply of unfinished homes? Unfinished home is just a nice way of saying new construction. Those are the builders, okay? When he said that, I don't know if I agreed with it, but there certainly were homes that were in the process of being built that were coming to market. And if you were following stocks, or if you own stocks of KB or Toll Brothers or all the big builders out there, you've probably done very, very, very well. The unfinished homes, the new homes, I think he called them the finished homes, I believe. That's resales. That's what we do. That's the house that's got the neighbor living in it who's selling. So again, both of those clips are from 2 years ago. My thing with that is, that shouldn't be playing right now. Let's keep going.
A bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting.
Okay, so a little glitch there. I don't know if we're just going to let that run in the video or Adam will clean it up. I guess the next 30 seconds will tell. So let me see if I can back up a slide. Where I wanted to stop was, the previous was, hey, we need to do a reset. Real estate, in my mind, is in the target of the Federal Reserve. Extraordinary moves on interest rates, certainly impacting the mortgage business, certainly impacting the residential real estate business. And again, I don't dislike Chairman Powell. It reminds me, quite honestly, of what I used to do a lot of foreclosures with Fannie Mae and Freddie Mac, and they would make a policy that I had my little blinders on, and I said, I'm just trying to sell real estate out here in the Inland Empire in Southern California. why are you making this policy for me because it doesn't work for me? And their response was, we're not making the policy for you. We're making the policy for the entire United States of America because we can't have little itty bitty policies in Southern California that are going to be different than in Florida. So I get that. So the Fed, they come in with the hatchet, they do their thing. But, hey, I take all this stuff personally. It's targeting my area, my business. So the reset is what I felt we were doing. What I was supposed to do next is click and play the clip that just played. The one that he just played was from 6 days ago. I'm not going to play it again. At least I'm going to try not to play it again. But if you take a look at that, he basically said, we're not targeting real estate. We're not trying to reset real estate. So I'm going to click twice. We'll see if we get past this and see what happens. It looks like we got past it. So at any rate, so what's going on here? I don't know. How's that for a complete 180? That is a complete 180 where we were before. Before, it's housing, it's too fast. That changes now. We're going to reset. We're going to bring it back to a more normal, sustainable level. And now here we are 6 days ago that says, hey, we're not targeting that. We're doing what we got to do. Now maybe, I don't know, maybe he is, maybe he isn't. Maybe he's got to be a little cute with what he says and how he says it. But to me, that's a complete 180, which, by the way, that makes me happy. Okay, I like the fact that he's kind of going away. He's doing his thing. I do think they just came out. By the way, in the real estate business, when you hear good news, good job report is up, unemployment report is down. These are generally good things. The bond market generally hates those things in a way that negatively impact mortgage rates. So in other words, when we get good news in the economy, mortgage rates tend to increase because the economy is too hot, we need to slow it down, et cetera, et cetera. Having said that, I feel pretty good about where we are. I do feel pretty good that if you watch 60 Minutes, I don't have any clips from 60 Minutes, but if you just watch the 60-minute special this 3 days ago, they did an interview with Chairman Powell there. He says we're probably not going to cut in March, but we're going to deal with it later. That's fine. I'm okay with that. We don't have to cut. Just let's just slow down a little bit, get a little bit of normalcy. So let's jump back into our normal stuff. It's been raining, so that's why I've got my rainy day slides up here. Boy, I haven't seen this much rain in quite some time. So let's jump into our inland Southern California update. Again, there's some stuff in here I absolutely love. A couple things that you sit back and say, well, that looks like a little bit of a wet blanket. How do you love that? Okay, well, I don't love that, but I love this on balance because I think it's generally positive for where we are. So here's our median price for the 4 counties, okay? Orange County up, Los Angeles County down, and basically San Bernardino, Riverside County more or less flat, okay? The last several months I've been clicking into these charts, and I'm probably going to click a little bit less today. You guys can look at the slide deck. You'll find it on the YouTube page. You'll find it on Facebook. You'll find it on Instagram. You'll find it on the link tree, so you can look at these and you can click into them if you want. But basically, for the month of January 2024, a couple of the counties basically flat. LA County down a little bit. Orange County up in median price, okay? So that's the 5-year chart. These are the prices. I'm not going to click into this today. I have been. I'm just going to leave it be. You guys can do that on your own. I just kind of gave you the numbers. So this is kind of where we are price-wise. LA County is up 6%, even though it's down for January. Went down a little bit in January. It's up 6% from January to January. So January 2023, we're 6% higher in January 2024. Orange County's 13% higher January to January. Riverside 5.2, San Bernardino 8.6. So with the exception of Orange County, who's a little bit outperforming the other counties, if we sat back and said, hey, year over year, you've got appreciation between 5.2, 6, and 8, I think that's a wonderful thing. The market's not too hot. It's fairly reasonable. Most people in my world are like, hey, a 5% appreciation rate is reasonable. It's healthy. If you're a speculator, you're an investor, and you're used to getting a lot more money on your investments, you probably don't like that. But that's also been one of our problems is we have so many people looking at their homes as as Las Vegas slot machine roulette wheels that are always going to pay off, or the stock market, they're always going to pay off. And well, hey man, these are houses, they're in theory, they're homes, and we shouldn't be seeing these volatile swings. So I like 6%, I like 5%. So again, I feel really, really good about the pricing. So this is the 15-year chart, same thing. I'm not going to click into this. You guys can click into it on your own, but if you want to see 15 years of pricing data for the 4 counties, here it is. I showed this chart at a sales meeting earlier today to some of my agents who kind of surprised me that they hadn't seen it before, because they should be watching my stuff a little bit more. But this chart, I don't know that it really does it justice, but you can, if you guys are at home looking at this, you can drag your mouse along here and it'll give you the prices for the different points and the different months, and you can kind of, oh yeah, I remember that. This was 2009, this is when we had all the foreclosures, and this is when we peaked, and this is COVID and all the rest of that. And then these little negative bars coming down here, that's when Chairman Powell was raising the interest rates. So anyway, prices are stable to up in January. Goodness gracious. How can we complain with that? I certainly can't complain with that. New listings. It doesn't reflect very well. Actually, maybe it does. If you see these steep V's going up here, this is what I was hoping was going to happen. It did happen. I hope it continues to happen. But basically, in all 4 counties, we saw what I think are fairly dramatic listing increases from December to January. So basically January just pumped things up. Now, why am I excited? Why did I think it was going to happen? Because if you just look at this 5-year chart, guess what? January, 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 January. Shocking. So God forbid we actually have a few things that actually kind of are somewhat predictable. That's why we do this. We're looking for trends. What is the trend? The trend says we should be going up. We are going up. Now there's a couple more charts on this, and again, I'm not going to click into these just now. You guys can click into this if you want. But one of the reasons I feel pretty optimistic on this is if I come down here on these listings, every single one of these county bars are all-time lows. As a matter of fact, let me click to the next chart. These are the numbers for that chart. Let me see if this is what okay, I'm going to come back here. This is one we put up a few months ago. We started using this, and we've kind of referred to this as our real estate EKG. You know, if those of you ever had your heart monitored, does it look like that? Well, all of these lows for all of these counties, and boy, do they match. I don't care if you're in Orange County, Riverside, San Bernardino, you know, they all look how they just track. But every single one of these lows is basically approximately January. But the lowest don't get any lower than December of 2023. So when we see that number going up, and by the way, this is the chart from last month. It doesn't have the spike going up. I'll go back 2 charts. It doesn't have this little tail coming up here. We've never been lower than we were in December of 2023. So I'm hoping, I'm thinking, I'm expecting that was the bottom of the bottom. Okay? So I guess we're going to find out as we proceed. But I was very pleasantly unsurprised at the January listing numbers. So, and we're seeing some things in our office that make me very much more encouraged if I'm in the real estate business. Quite honestly, even if I'm a buyer now, a few more listings to choose from. Yeah, but Lance, what happened to interest rates? Well, we'll talk about that in a minute. So anyway, the listings, excuse me, we're up in January. It's exactly what we want. So now let me throw the wet blanket on a few things. Well, what about the pending sales, buyers and sellers actually coming together? Well, all 4 counties, the open escrows, the pendings were down, okay? Except for Riverside County. Oh, let me back up. Sorry about that, guys. Actually, I think I do need to click into this one. Pending sales, let's take a peek. So boy, epic fail. Let's try this again. There we go. This is what we're looking for. So these are the pending sales for the 4 counties. All of them are down except Riverside, okay? When I saw that, that didn't surprise me because we do a lot of our business in Riverside County, and we had a much better than average January for opening. These are pending sales, buyers and sellers coming together, opening escrow, doing their thing. Now, if I was in LA, San Bernardino, or Orange, well, okay, that didn't happen quite the way we wanted to, but I think that's okay. I really, truly think that's okay. The listing inventory is really what we're looking for there. So these numbers make me feel pretty good. I'm very happy with those particular numbers. I think at the end of the day, they're exactly what we want. And I think we're going to be looking pretty good moving forward. So the pendings were a little bit down, but the listings were up. And I'm okay with that. So January started off, in my opinion, a little bit better than average. These are those numbers on the pending sales. Now, wait a minute. I just talked about prices, 5, 6, 7%. We still got these gigantic negative numbers on pending transactions. This is why you still, if you're in the business and you're sitting back and saying, well, geez, Lance, it sounds like you're a little more optimistic, but the sales don't seem so great. Well, you're right. 34% fewer transactions year over year in LA, 33% fewer transactions in Orange, 16% fewer in Riverside, and 20% fewer in San Bernardino. So we still have a transaction volume problem, but a lot of that has to do, so we just have not had enough houses to sell. So we'll see. So we got a few more houses to sell. Inside Coldwell Banker Town and Country, our pending transactions for the month of January and frankly for the first 6 days of February, I mean, we're not setting records, but I got to tell you, I feel pretty good. So hopefully that trend continues and we get a little bit of help from the Fed on interest rates, et cetera, et cetera. So here's that 15-year chart on pending sales. Again, it doesn't get any lower. These are the lowest of the low. So do I dare say it can't get any worse? Because of course it always can, but you know what? I don't think it's going to get any worse. I think we've seen the worst of it behind us, and even though interest rates have been a little bit funky, we saw some improvement, and then we saw some less than improvement, and we saw some backfilling and some increases over the last week. I still think we've seen the worst. I think it's behind us, and I think psychologically, the buyers and the sellers just say, hey, this is where we are. And I think it's taken us a couple years to get to that point. So here's that 15-year chart. You guys can click into it if you want. I'm not going to click into this. All these spotlight cities I'm leaving up. So if you're interested in Covina, there it is. Claremont, these are where I have offices. Moreno Valley, Redlands, away you go. So Rancho Cucamonga. I've had a few people said, hey, Lance, could you give me this particular city? I haven't put them on this deck. Just call me, text me, email. I'll send you whatever you want. Now, a couple little things I thought I'd share with you as we kind of wrap up today. I've been doing a little bit of work down in the Coachella Valley, more property management stuff than sales. I'm very intrigued by what's going on down there. And our property management company, Cobalt Property Management, we're pretty big in Inland Empire, West San Gabriel Valley, but we haven't really done a whole heck of a lot down in the Coachella Valley. Well, that's going to change. So I'm down there looking around, poking around, turning over rocks and seeing what's going on. And I'm learning. So the reason I'm sharing this with you is whoever you're going to do business with, Lance Martin, Drew Martin, Drake Martin, the Martin Group, Coldwell Banker Town and Country, you better make sure they know what they're doing because it's very easy to get deceived and very easy to misinterpret some of this data. So why am I telling you this? I ran into something that I thought I would share with you. You can apply this to your own home, your own market, because what might look like something on the surface could be completely different when we dig into it. So what am I talking about? I did a spotlight city of Riverside about 2, 3, 4, 5 months ago. Population in Riverside is 317,000 people, and that's as of almost 3 years ago. I guess that's a census number. I just Googled it. It sounded a little light. I thought the number was higher than that, but 317,000 people in the city of Riverside. I'm not going to click into this, but if you click into listings in the city of Riverside, there's less than 300 listings in the city of Riverside. That's not a lot of listings, okay? So why do I tell you this? Well, because I've been doing some stuff. I've been looking around. I was in Palm Desert looking at some rentals, looking at some house for sales, and the population in Palm Desert is 51,000 people. It's about 6 times smaller, or Riverside 6 times bigger, give or take, than Palm Desert. I am going to click into the listings in Palm Desert, and I'm going to sit back and say, again, it's kind of smaller data sample, but if I click on this number here, I don't know how well you can see that. There's 313 listings in the city of Palm Desert with 51,000 people. There are more listings, these are homes for sale, in the city of Palm Desert than there are in the city of Riverside that has 6 times the population as Palm Desert. Now, when I first saw that, I thought, wow, that's a little bit of an issue. That's a little bit of a problem. What's going on here in Palm Desert? That's a problem. Or what's happening here in Palm Desert? And then I sat back and said, hey, well, let's do what I do. I'm a data guy. Let's take a look at the data. This is a 5-year chart of Palm Desert. But then what I realized is that's just Palm Desert. Palm Desert just has a huge amount of turnover, a huge amount of listings, which, by the way, if you don't look at the data and you just kind of think about it, it just says, wow, something bad is happening there. There's way too many listings. In theory, prices should be cratering. We should have some problems and all that. Well, none of that's happening. None of that's happening. So we look at the numbers a little bit differently, and you sit back and say, you know what Palm Desert's doing? Palm Desert's doing Palm Desert. Riverside's doing Riverside. So point being is, when we take a look at these market snapshots on these individual cities, I think we all just need to kind of be a little careful and just realize that not all the time does the data actually kind of look like what you might initially think. That's why you need a professional. That's why you need me and my team to help you out with that. And I just love this stuff. So if you're thinking about buying or selling in Palm Desert, all I can tell you is come on down. The water's warm. There's a lot of inventory to choose from. Prices are stable. And it's just a very interesting, beautiful marketplace. Obviously different than Riverside. But that population variance just, frankly, I just found it astounding. Okay, we're going to wrap up today with interest rates. We kind of started with Chairman Powell. Why do we talk about Chairman Powell? Because we want to talk about interest rates. So here's our rainy day session again. So this is, oh, by the way, this was last month's slide. Rates were below 7. The 10-year bond was below 4. Well, I can't say that today. Rates are now above 7, and the 10-year bond is above 4. So, man, oh man, it is what it is. We're going to be fine. So this is from Optimal Blue. Their indices of mortgage has an average at 6.7. Lance, I thought you said they were above 7. Depends on what you're looking at. So, but this is an increase. If you come all the way down here, this is where we were last month, and this little uptick is what we've done in the last 4 weeks. Interest rates have, actually the last 10 days, interest rates have worsened, if you will. They've gone up on the mortgage side. This is from the old Google machine, basically the same search. It's at 7.3. It is what it is. This is my new love I've been telling you guys about. I absolutely just love Mortgage News Daily. This is the one, if you use the slide deck and you click on this link, every single day or whenever you want to, or you can download the app on your phone. It's free. This is what I use. This thing is dynamite. But at any rate, 7.4. Again, these are all increases of about 0.5 point from where we were 30 days ago. And then this really sums it up. So this is my favorite chart. This is what's going on in the marketplace in general. Anyway, I saw this on the interweb, and I just thought it was funny as hell. So a lot of odd, crazy stuff going on out there. So on balance, though, I'm feeling pretty good. We started off January as I had hoped, somewhat as I had expected. And even though interest rates are still a little bit volatile, I generally think it's going to settle in. And there's still a lot of people, myself included, that are looking at interest rates to come down below 6 some point this year. Below 6 at some point this year. So we'll see whether that happens, and I'm on the record. So our market forecast again is we'll make the announcement coming up in April. Again, we are Coldwell Banker Town & Country. Cobalt Property Management. Cobalt is our escrow division as well. And the Martin Group is myself and my 2 boys. We'd love to do business with you. We are done for today. Have a wonderful February, and we will see you next month.